going to be moderating the broadcast here today. Before we get started into the main part of the meeting, which is the understanding professionally managed futures, I did want to ask 3 polling questions that you could write the answer down. If you could have a pen and paper handy, that'll come in great as we continue to have the broadcast come out, so you can take notes and questions you might have so you don't forget them. But basically, I'm going to start out with 3 polling questions to start out the webinar to get acquainted with the specific interest that the attendees may have. The first question is are you interested in short-term, out-of-the-money S&P 500 option writing? Again, short-term would mean that the expiration date is relatively short-term. Out of the money would mean that the striking price on the call would be higher than the current price, and the striking price on the put would be below where the current price is trading right now. The S&P 500, we know, is the 500 stock index. And of course, option writing means that you'd be the writer or the seller of the option. And how many of you are interested in that type of strategy? Question would be how many of you are interested in options or contracts on different markets such as the stock market index or currencies against the US dollar or treasury bonds, treasury notes, euro dollar deposits, or crude oil, unleaded gas, natural gas, or gold, silver, copper, grains like soybeans or corn, or many others. If you have any interest in that, please jot that down. And finally, how many of you are not satisfied or you would like to change the balance in your portfolio and you're open to alternative investment ideas? Okay, so those are 3 polling questions. If you could write down the answers there, and then either at the end of the broadcast, get my phone number and let me know where your interests are. I could try to get information provided to see what, if any, of these ideas and markets might be right for you. My number, if you'd like to write it down, is 702-873-5707. This is Jim Kenny, and 702-873-5707. Okay, by way of introduction, I am Jim Kenny, and I'm the branch manager here for High Ridge Futures. HRF is an introducing broker, and HRF has a clearing relationship with ADM Investor Services, which I'll discuss at greater length at the end of the webinar. Now, a quick background on myself. I am a graduate of Boston College, and I've been registered with the NFA for over 30 years. I passed examinations during my career, including Series 3 and Series 30 for branch manager, and I believe that I have the knowledge and experience, and I'm qualified to explain the uses and the risks of diversifying with managed futures to qualified, suitable investors, and I'm going to begin that process right now. Now, I am going to be going through lots of different information here, and there will be some studies that compare indexes of CTAs or commodity trading advisors and also indexes that are representing stock. Be aware that this is for illustrative purposes only, and that it is not representative of any specific one trading advisor or any one stock. So obviously it is not going to be relevant particularly to you as far as which advisor you take and comparing it to whatever stock you might own. But for an illustrative purpose only, you'll see how the 2 indexes do compare. Okay. All right. The next thing we do at the beginning of every broadcast is we do go over the CFTC disclosure statement, which is right there on the screen. Now, obviously, no statement like this or any other could be exhaustive as far as all the disclosures you need to know in the subject area that we're talking about, but this is a start. And at the end of the day, some of the major points in the disclosure statement include that this trading is not suitable for all investors and that there is a risk of loss no matter who is managing your money, and that there are disclosure documents which are more comprehensive as to the methodologies, the risks, the fees, the incentives, and the backgrounds of each and every specific CTA. And of course, I'll be referring to this statement quite often throughout the broadcast as I do refer back to historical data, and that statement is very important. It is that past performance is not necessarily indicative of future results, and do remember that as we go into the historical numbers and talk about them. Okay, All right, moving right along here, I am going to go into some thought-provoking questions. Now, here you go. Some charts that do some comparative studies on these questions that are coming up, but here are the ones right in front of you. One is during the 5 worst periods declines for stocks since 1987, how has managed futures compared? Second would be the 15 worst quarters for stocks over the past 25 years. How have managed futures compared during that? Next one is going to be the most critical events that have occurred over the last 35 years, and how has managed futures compared with stocks. And next one here is for the very worst stock market declines in history since 1987. How have the managed futures compared during those periods of time? Now, again, this is going to show you comparative studies using indexes. And again, there are limitations to that from the standpoint of it's a limited universe of CTAs and a limited universe of stocks. So obviously, the comparisons, while illustrative, do have limitations to them. Okay, now, as far as the asset class of this managed futures, over the last 16 years, as you can see on your screen, total assets invested in managed futures has grown by 796%, more than it took to grow in the previous 20 years. And that's reaching a major milestone at the end of 2016. You know, according to Barclays Hedge, they're one of the oldest and most respected providers of alternative investment data. The managed futures is the fastest growing alternative investment strategy today. So that's quite a statement, and it is backed up by numbers. Moving to the next area here. Just let's get a definition out on what managed futures are all about. Okay, well, a managed futures account is one where a registered commodity trading advisor, they're called a CTA, is given responsibility to make all the trading decisions. Now, this authority is delegated by the account holder to the CTA through a limited power of attorney, which may be withdrawn at any time. Now, the CTAs are registered with the CFTC, that's the Commodity Futures Trading Commission, and that's an agency of the federal government. And they're also members of the National Futures Association, which is called the NFA. Now, that's a self-regulatory organization that was created by Congress, or authorized by Congress in 1982. So it's been around for a very long time. CTAs are professional money managers who manage the investor assets using instruments in the commodity markets. Could be stock market index, or it could be on individual commodities, depending upon the manager. And basically, in a similar way to the way the stock mutual fund manager would invest his client's money in a variety of different stocks. The thing is people do use various accounts to use these managers when they're suitable and they are interested in this kind of diversification. They can use individual accounts, of course, but they can also use qualified retirement plans like the IRAs and the trusts and the pensions. While not right for everyone, for sure, this is a situation where there are people who diversify with this asset class in those. Okay. Turning to the next area here is the growth of the managed industry. I alluded to it with that number of 796% jump, but take a look at the chart here, and that puts it into graphic detail. In the last 16 years, assets under management for the managed futures industry, again, has grown approximately an unprecedented 796%. There you go. If you look at the bottom there, 1980, kind of flat, starts picking up around 87. After we had the crash, people start diversifying out of stocks, I guess, a little bit. So then it goes a little bit on a higher level into 2000 when we had the next crash with the dot-com. And then after the dot-com crash, they really started diversifying into this area. And you can see a pretty parabolic jump there into 2008. Not much of a hiccup during the crash of 2008 as far as the assets coming into this asset class. But we have seen, again, another big jump between 08 and current prices, as you can see. So, again, while not right for everybody, it is clear that money flow going into this asset class has occurred. And, of course, that's the past. So, again, past performance not indicative of future results necessarily. So, again, it is what it is as far as historical information. Okay, turning towards the next area. Growth of the managed industry. There we go again. 1980, there's less than $1 billion in the managed futures. 2000, there's a 37.9. So pretty good jump in 20 years. But there we go. At the end of the fourth quarter of 2016, there was 339.7 billion in managed futures. Well, that's quite a jump in 16 years from 2000, as you can see. So again, that's just showing you money flow going into the asset class. And again, according to Barclays Hedge, they do see it as one of the fastest growing alternative investment strategies. So that just gives you a little data. Turning towards the next year, we're going to start doing some comparisons, and we're going to do some comparing indexes, which track the CTA indexes versus the S&P 500, which we all know pretty much, or not everyone, but most people in the market for any length of time know that the S&P 500 is a broad-based stock index. At any rate, there have been studies, right? And here, the late Harvard professor, Dr. John Littner, he did a study, and he concluded that the managed futures can, doesn't mean will, but can increase the performance and reduce the risk in an overall investment portfolio. It is important to note that the study below is not based on academic theory. Now, there you go. You can see that when you compare the S&P 500 and the actual performance and the BTOP, that's the Barclay Top 50. That's an index comprising the largest trading advisor programs as measured by assets under management. So there you go. It's a very favorable comparison. And again, this is index versus index. So again, when you have your own manager and you have your own stock, the comparisons may vary, of course. Okay, turning towards the next one. Performance of the Barclay Top 50 Index during the 15 worst quarters that the S&P has seen going ways. Looks like it's going back to about 1987 here, right? So obviously we had the Black Monday, and the S&P 500 total return index minus 22%, but the Barclay B Top 50 was better, at a positive of 1688. Difference there is a very big differential. Then you've got other times where we've had very tough quarters, like 08, obviously, when we had the mortgage crisis and the debt crisis, et cetera. Then, of course, in 2001, 2002, we had the horrific 9/11. We also had the coming off of the dot-com bust. 1990, of course, we had the situation with Iraq and Kuwait. And then again, 2009, 2010, you've had the European sovereign debt. Well, if you look at those total return index on the S&P 500 results and you compare it to the Barclay B Top 50 index, the comparisons are rather favorable. And of course, these are historical numbers. Again, past performance, not necessarily indicative of future results, but the numbers are what the numbers are. Okay. So there you got some comparative studies during that comparison between the CTA index and the S&P 500. Let's turn to the next one. CTA return during periods when they lost more than 10% in a quarter. 1990. There you go. They're comparing. Now they're using autumn gold here, autumn gold CTA index. Okay. Now that reflects the autumn gold CTA index. It reflects the average performance of CTAs reporting to the Autumn Gold database. So not every CTA reports. So that's why these are limited in scope, because they only contain certain CTAs. Just like the S&P 500 does not contain every stock on the New York Stock Exchange. So I'm trying to make that point here. I think it's pretty clear by now. But the favorable comparisons are there right in front of you. And again, historical information. So you have to keep that in perspective. Next one here. Is the critical events, January 9th through June 2016. I don't know how many of you have been out there for a length of time in the markets. I had been involved in the markets back then, so Black Monday obviously was a horrific time. Then you got the Persian Gulf 1990. Then you jump over to the horrific 9/11. Also, before that, you had long-term capital management who lost, at the time, was a huge amount of money, $4.6 billion. And then you move up to the subprime mortgage crisis, and then the U.S. debt downgrade, and Brexit vote. And you can see that during these critical events from 84 to the present, the comparative studies using the CTA index, and this time we are going to compare it here to the Dow Jones Industrial Average of 30 blue chip stocks. And the index they're using on the CTA index is equal weighted index of CTAs maintained by the Center of International Securities and Derivatives Markets at the University of Massachusetts Amherst. So again, this is a different CTA index, but the comparative study is favorable, albeit it is historical in nature. Area here on this is going to be the managed futures performance during the worst stock market's declines in history. So that comes up here. I guess the history would be from 87, but at any rate, crash of 87, S&P 500 minus 23.3, beat Barclay top 50, positive. Terrorist attack 9/11 minus 14 and change on the S&P. 11 and change on the Barclay top 50. You have Iraq attack, Kuwait, and then you got that comparison. Again, the Russian defaults and the tech bubble and the stock market crash of 08, and you can see the comparative studies here are favorable when using the S&P 500 basket of stocks, comparing it to the limited scope of the Barclay top 50 index for the CTAs. But it's more data for an illustrative purpose there. Okay, and you got here the effect of allocating 20% of a traditional stock bond portfolio into the. Now, the concept here, and again, it's not an assurance of the future result by any means, and of course, results can and will vary, but they are saying if you use the index of the S&P 500 and you also use bonds represented by the Barclay U.S. Aggregate Bond Index, and then, of course, you include something in the area, and the managed futures will be represented in the old CTA index. It does show that the effect of reallocating 20% of a combined stock bonded portfolio, stock and bond portfolio, to managed futures has a favorable result looking backwards. Again, past performance not necessarily indicative of future results, and of course, there's no guarantees that anything will be repeated here, nor again that managers will be able to replicate their results. So, but for illustrative purposes only, it does show you that on a non-correlated situation, which managed futures attempt to be, that it can change the risk profile and the return profile of a standard stock and bond portfolio. That's the concept. And again, there's no assurance that'll be reality, but that is the idea, that it's a non-correlated situation because it's not exactly in stocks and it's not exactly in bonds. And ergo, the belief is that it may not be correlated to either one of those two on a one-to-one basis. Okay. All right. Turning towards the next area here, performance results of a 30 comparing managed futures, U.S. stocks, and international stocks. Here you've got three things being compared. Okay. And as you can see, the comparative study, again, is favorable towards the managed futures versus U.S. stocks and international stocks. In fact, international stocks have lagged both the others on a performance basis between 1980 and 2017, February, by a whole lot. So there you go. The numbers, again, past performance, not necessarily indicative of future results, but that does illustrate the comparative differentials using those indexes as I'm showing them right now. Okay. And again, going back here to the risk reduction and performance enhancement. Again, that because they are not specifically in exactly stocks or they're not specifically in bonds, the studies using indexes of all those, the hope is, the idea is, the objective is, uncorrelated feature of the managed futures will obviously change the risk profile and the performance profile because they're not one for with the other market. No assurance that that's going to happen, but that's the objective, that's the goal, and that's the idea. non-correlated connection to the stocks and the bonds. All right. Now let's talk a little bit about amateurs versus professionals. Okay. The opinion we have is that the most prudent way to participate in the commodities market at this point is the CTA approach for suitable and qualified people, and of course, interested people. The CME group had a report that they published saying, obviously, that some individual investors who have the know-how, the time, the access to information, the necessary temperament, and all that kind of stuff could be highly successful in directing their own futures trading or all types of trading. But they did show in their study that, unfortunately, the record does not bear out that the majority of people do work out that way. And so the studies indicate that somewhere between 2 out of 3 or 9 out of 10 end up having a loss. And although some CTAs have shown achievement consistent returns in volatile markets, there's no assurance that they will, but they are suggesting that there is some worthwhileness to investigating the CTA or the professional approach. Now, HRF has a number of trading advisors, CTA, commodity trading advisors, in their inventory of approved advisors, where due diligence has been done and they are now available to clients. I have zeroed in on 3, and I'd like to discuss them with you briefly right now. So as far as what I have zeroed in on, the first advisor, and again, this is for suitable people and people that have the wherewithal to diversify part of their portfolio. The first trading advisor is called the White River Group. And the White River Group is managed by a gentleman named Andreas Diesbacher. And he has 2 different programs. The first program, which is the original program, is called the Stock Index Option Writing Strategy. And basically, that strategy has been around since 2008 November. And in that strategy, again, I have a tear sheet here that can be made available to you. I'm not going to read every number on it. And there is a disclosure document that comes out that goes over all the details in the methodology, the performance record, the background of Mr. Diesbacher, and the risks and other everything you want to know about his approach in this program. But going back to November 2008, the results, and again, past performance, not necessarily indicative of future results. I am reading off of historical numbers here. Since the start date, and this is going to take me through the end of March. He did have a positive month in the month of April. I can update you on those numbers later, but this is going to be giving me just through the end of March. Since November 2008, the total return since inception was 159.18%, just a shade under 160%. Compounded annual return was just a shade under 12%, compounded annual return at 11.98. And then the winning months versus losing months, out of 101 months that it's been around, 82 months have been winning months, and losing months have been 19. For those of you sophisticated enough to know different ways of gauging or measuring risk-adjusted returns, in this particular stock index option strategy program, the Sharpe ratio for 3 years is 0.42 going through the end of March, and cumulative was 1.11. Sterling ratio was 0.31, and of course on the cumulative was 0.31. And then the Barclay ratio for 3 years was 0.36. Cumulative is 1.35. Efficiency index 0.43, and a cumulative for the efficiency index is 1.12. So I do think that this particular manager is worth looking into for those of you who would like to look into diversifying with a manager and with a gentleman with a strategy that he's employing. And I will also give you now his second program, which is called the Dynamic S&P Options Strategy Program. Now, this one has not been around as long as the original. He has changed a little bit of his techniques from the original, mostly regarding strike price and expiration dates. But this one's been around since November 2014. And going through the end of March, the cumulative, or shall we say the total return since inception, was 32.83%, just a shade under 33%. And the compounded annual return was just a shade under 12.5% compounded at 12.47. Now, his winning months to losing months through March of this year, and again, he did have a winning month in the month of April. I will be able to update you on that as well. But going through the end of March, his total months this has been around is 29 months, and the winning months were 28 months, and the losing months were only 1 month. His risk-reward ratio are as follows. Sharpe ratio, 1.50, cumulative 1.50, Barclays ratio 1.98, same with cumulative, and the efficiency 1.53, and the efficiency index cumulative the same, 1.53. Now, there are many things to learn through the disclosure document, the tear sheets that can be made available to you, but one thing I think is important, and again, this short broadcast, I cannot get into every single thing. That's why you need to get the tear sheets and you need to get the disclosure document. But I would say that I find it very attractive that their compensation of the manager is a percentage of profit or an incentive on the growth of the account. So they have a vested interest in the account growing month over month, as they do get a profit incentive percentage on net new profits. What that means is if there's a loss, the incentive is suspended until the loss is made up. And again, I find that very attractive, in my opinion, as a part of the fact that they do have a vested interest in the account growing. Okay, the next manager that I've zeroed in on is called Pacific Front Capital. Now, there are differences between these two managers of substantial amounts in that their strategies are quite a bit different, and also the length of their records is quite a bit different. And so basically, this trading advisor, Pacific Front, they have a track record from last year. And so last year was their first year, and but it was quite an attractive year from the standpoint of their results. Now, again, past performance, not necessarily indicative of future results, but here's what happened last year. First of all, their cumulative return, excuse me, not their cumulative return, their return since inception for all of last year, essentially, is 128.45%, just a shade under 128.5%. And that was for 2016. The worst drawdown in any 1 month was 9.58%, just under 9.6. That was the worst monthly drawdown last year. And then the average monthly return was a bit over 10%, and that was 10.28%. And basically, that was their average monthly return, which obviously is a high rate. Now, again, past performance not necessarily indicative of future results, so keep that in mind. But their Sharpe ratio, for those people who like to look at an analysis of the risk-reward ratio, here's what you've got. The Sharpe ratio is 2.68. The Sortino ratio, which some of you watch, it looks like that Sortino was 9.58, and basically the profit-loss ratio was 10.8. 10.88. Okay, now again, this is not right for everybody, but to find out if it's right for you, the available information is out there for you. And what I'd like to say also is that this gentleman here, who runs this program, he also, in part, is compensated with an incentive on the growth of the account. And should there be losses, that percentage into net new profits incentive would be suspended until the losses are made up and net new profits occur. So I find that attractive. I don't know how you out there do, but that's just my opinion. And again, past performance not necessarily indicative of future results. But let's say you decide after looking into this further, looking at your portfolio, and you'd like to possibly move some money. Either A, maybe your portfolio is at a significant jump and you want to balance it out a little bit further with a new asset class that you don't have. Or B, maybe you just want to go into a new asset class and see if you could balance out, or not balance out as much as diversify your portfolio. And you decide you want to proceed. Okay. Well, let me show you here, answer some questions for you that you might find helpful. Okay. Say you decide to proceed, you want to hire one of these managers, and you want to get an account started, okay? After you've looked at the disclosure document and you've determined that this might be suitable for you. Okay, where is my money kept? Client assets are held in a customer segregated account at ADM Investor Services. Now, this is an established financial institution, and it is in business for over 50 years, ADM Investor Services. How accessible are my funds? And then basically a managed account usually offers a high degree of liquidity. Now, again, we don't recommend this as a short-term vehicle, but rather a long-term managed account asset. But this is your money, and you can make your decision as you see fit. So part of all your funds could be available at any time. Now, is my money in a managed futures account safe? Well, your funds are kept in segregated accounts in your name. CFTC regs prohibit FCMs, future commission merchants, from commingling segregated funds. But the segregation of funds does not absolve you from losses should they occur due to trading. But as far as the segregated accounts, they do exist as such. Now, you've got an account going, and now how are you going to follow along? Here's how you follow along, okay? First of all, like you do now probably, you can go into the internet and using a username, you can access your account and look at exactly what your positions are each day. This is not a pool. You have your own positions in your own account under your name or whatever the entity is. And basically, that's what you can look at 24/7. Okay? So you have access that way. Second thing is, obviously, you can call the office and talk to somebody. And then the third thing is, if there's any activity, you will have a activity generated statement sent to you. And every month, of course, you will have a monthly statement. So between the 24/7 access by going on the internet and looking into your portal, and then, of course, talking to somebody if you want to call in, and, of course, an activity statement and a monthly statement, this is a situation where the transparency is very, very high. In my opinion, much higher than many other investments out there. Again, you have your own positions, you have your own account, okay? All right, so that's basically how that works. Now, the final thing that I wanted to cover for many of you out there that you might find quite interesting is the idea of, are there any tax benefits to investors? And the answer is yes. According to the Tax Act of '81, short-term profits on commodities are treated 60% long-term, 40% short-term, and on the other hand, short-term trading profits in stocks are treated as 100% short-term. So a short-term investment is known as one that is held for less than a year. This favorable tax treatment in the commodities can translate to investors in the upper tax brackets to as much as a 30% savings on taxes in short-term capital gains on this type of vehicle versus stocks. Now, again, we always say this, that your tax advisor regarding your individual tax situation, but for those of you who get a big bite every year when you go do the taxes with all the different gains that come in, this might be very interesting for you to investigate as another reason why diversifying into this vehicle might make some sense. Again, nothing is right for everybody. To find out if it's right for you, I'm obviously inviting you to get more information. And again, in order to do that, you simply have to get a pen and paper right now, if you could, and write down my phone number, and I'll give you my name again. And you can call me either after this broadcast, or you can call me first thing in the morning during business hours. I would be very happy to give you further details on the managers, and also give you answers to some of the questions you might have. So again, my name is Jim Kenney, Kenney, and my phone number here is 702 and then 873-5707. Again, 702-873-5707. So again, Jim Kenney, I look forward to hearing from you. I do want to thank everybody who's come today to learn more about this asset class. Some of you have some knowledge about it. Some of you it might be new to. And the first step to anything is to get information and then find out what, if any, of these might be right for you. As always, thank you very much for attending. And I always close out by saying good luck and good trading. And I look forward to hearing from you and getting you the information. Good night, everybody.